Hello traders, welcome back to the FOREX channel. Today I'm going to talk about trading psychology and how you can help and improve your trader psychology. I personally think you can't teach it, so you can't go to someone and say, teach me how to master psychology in the markets like you. So I'm pretty much just going to give a few tips which I found from when I started, a couple years ago now, in 2019. So I've had a few years experience, now I trade full time, so I kind of know a bit of what I'm talking about, I guess, more than some of these guru people on YouTube which literally don't trade. So I'm gonna say a few tips which I wish I heard when I started from a lot of these YouTube videos that can hopefully help you. And if they do help you, drop a comment down below, leave a like, or even subscribe to the channel so you don't miss any of my future videos, which I do upload a couple of weeks now, keeping consistent. The first point I want to make is don't go straight into the deep end. I see a lot of traders, I know some traders, which they say they don't have a lot of money, or they haven't ever traded a lot of money. They go straight in, max FTMO, or max funding with another company. They'll go straight in, 100k, 140k. I think you can even get up to 400k. And I think when you're doing the challenge and the verification, the psychology is very different to when you actually get the funded account. I definitely think doing FTMO is good if you don't have capital. And the thought of it not being your money does help, but also that can make you overtrade, break the rules that FTMO have, which are there to keep you in line as a trader. And yeah, seeing that amount of profit and loss. So say you've got the $400,000 account, each loss is going to be $4,000. And if you've never seen that sort of money before, you're going to, as soon as you're in a few £1,000 profit or a few £100 profit, you're going to want to close. And then when you're in loss, you won't want to, take a $4,000 loss, even though it's only 1%. But, a lot of new traders that haven't traded large amounts of capital before, it's quite overwhelming for them. They risk more than they should. They overtrade. And I'd say personally, from experience, start small. So say you're a beginner trader, start with maybe 250 to 500 pounds. That's a perfect starting amount. I mean, if you can't afford that, then start with less, because I personally think if you are a good trader and you do have the skill set, then you can trade small account to a large account very, very easily. And a lot of people say, oh, I don't have the capital to trade. I don't believe that's an issue for anyone really, because if you've got the skill set and you believe you are a good trader, then trade that small account, compound it into a big account. Trading is not a get rich quick, and a lot of these people think it is, that they should have tens of thousands, hundreds of thousands of pounds of capital as soon as they start trading, which in reality is never going to happen. So maybe start small on a £500 account. Aim for, let's say, 10 to 20% per month. Once you're getting between 10 and 20% per month, then you can pass the FTMO, which is only 10% in 30 days, I'm pretty sure, and then 5% in 60 days. So once you're able to do that, start with maybe the 10k FTMO and build your way up to 25k FTMO, 35k FTMO, 70k FTMO. And once you've done that, maybe do another 70k FTMO. Combine them, you've got £140,000 of capital to trade with. And then instead of making £50 on your £500 account when you make 10%, instead you'll be making 14 grand per month instead of that 50. So once you've mastered the skill set, then you can either trade a small account of your own capital into a larger account, or use the money you've made from trading that small account to take a challenge or any funding programs. There's loads out there now, just take any of them. Also, what I see a lot of traders do is they have a strategy they're set on. They've been trading it for a few months, they've been back testing weekly, they're in profit, they're profitable, but then the losing streak comes. If they lose maybe 3 to 5 trades in a week or in a few weeks, they'll be like, this strategy, it's not the one for me anymore, I can't trade this strategy. And this is just a very, very bad situation to be in, because obviously no strategy wins 100% of the time. My strategy, I've had a losing week this year. It's only been one, but I've had a losing week. Sometimes you do doubt your strategy, Are the market conditions changing? Is my strategy not good enough anymore. What have I done wrong? Am I a bad trader? You start to think these sort of things. You start doubting your trading, that you're not good enough, and that you don't have like the skill set to actually trade. But what you need to remember is no strategy will win 100% of the time. If you have a 1 to 2 risk to reward minimum per trade, all you need is a 50% win rate and you'll be in profit. Just think about that, do the calculations, and if your win rate's above 50% on average, say you take 100 trades, you have a 50% win rate. You could win 50 in a row and then lose 50 in a row, but as long as you stick to risking that certain amount per trade, stick to the 1 to 2 risk to rewards, and out of those 100 trades, you'll still be in profit, even though you might have had 50 losing trades in a row, which can happen. Say you've got a 70% win rate, you could win 70 in a row and then lose 30 in a row. So you have to lose those 30 trades to have a 70% win rate. That's what a lot of traders don't talk about. It's just wins. But obviously wins aren't everything in trading. Losses are what make a good trader, and they can recover from those losses and not revenge trade, as I see a lot of traders do. And that actually brings us on to the next point in the video, which is FOMO. You don't want to FOMO into trades, and FOMO, if you don't know, is fear of missing out. I see a lot of traders, so say I post a trade on my Instagram story, sometimes I post the trades that I'm in or the signals I've been sending to my group. They'll just enter because I'm in that trade, and I won't post obviously as soon as I've entered. I'll post when the trade's already playing out or played out, and they'll be entering, no stop loss, just fear of missing out on the move, and then they'll lose a lot of money if price pulls back. And a lot of people just over leverage just for the sake of it, because they see that I'm entering a trade or their favorite trader is entering a trade. Or if they look on the markets, if we look on the markets now, you can see that this trade that I called in the group, is pushing right up now, but our entry was down here. So you might see a new trader see this and be like, oh, he's targeting up here, so let's start buying now and wait for price to come up here. But say price pulls back down to here and then moves back up, then they've had 100 plus 150 160 pips in drawdown just because they didn't want to miss the move. And you're not going to miss these moves. They happen every day. You could have caught this move, could have caught this move, could have caught this move from here. There's moves happening obviously every single day. So just because you missed one, you still have 249 extra trading days in a year, I'm pretty sure it is, where you can look for more trades. There's more than one pair on the market that you can trade. There's more than one opportunity that you can trade. There's not just one opportunity, and if you miss that, you're not going to make any money for the month. It's not like that. You're not going to be called a bad trader because you missed one move. And this is what a lot of traders just don't think about. They just FOMO into trades, and say they miss their entry, they'll just get back in if price starts moving in their favor. But say if I show you an example here, so say price is coming up, it's bouncing off their area here and they want to buy. They had a risk to reward thing set up like this. The stops just below here, let's say around 50 pips, and they were targeting up here. Let's say it was like this. They were targeting this high here, but they missed their entry. They weren't at the charts when their entry happened. So what do? They see price going up, so they enter here. They enter when price is already pushing up. So instead of having a 50 pip stop, instead they've got a 170 pip stop, and that's not even a positive risk to reward now, just because they didn't want to miss the original move. So what can price do now? It could push all the way up here and they wouldn't even get 1%. Or what it could do is pull back down to entry or even hit their stop loss, and say they had their risk calculated from here for a 50 pip stop and they entered the same lot size, then they would have lost over 4 times more, so 4.5% more than they actually should have lost in the first place, because instead of having a 1 to 5 risk to reward, 1 to 5.5 risk to reward, it's turned into a 1 to 0.83 just because they FOMO'd into the trade. And this happens a lot on quick moving pairs, especially on pairs like gold. If we look on like especially if you look here, this is even on the 4 hour. This price has moved away. Instead of price carrying on, we could have just had a deep pullback and then a move up. You know, it could have come back to tap an order block or something. And a lot of traders will FOMO in. They'll end up risking more than their plan allows them to risk, and then they might even lose the trade. They lose that. Instead of losing 1%, like in that example, they lost 4.5% on that one trade. So you've got to be careful. If you've missed your entry, maybe if price gets back to your entry and the trade's still valid, then enter again. If it's not, if the trade's gone without you, just let it play out, see if your analysis was correct, and then maybe set an alert. What time did that happen? Be on the charts when at that exact time again, to see if that same sort of thing happens at that time every day. Just something like that. Keep a journal of your trades to improve and slowly get better over time. Coming on from that point, I want to say, have a detailed trading plan. You don't want a plan that has, let's say you're a support and resistance trader, right? So say you have a support here. You had a break of this support, it comes up, you start selling. So that in your trade plan, it says break and retest, I sell or I buy. And you sell, it comes down. And then you don't take your profit, comes up, hits your stop loss. And then it comes back down, retest, you start buy. You start buying again. Price comes up, hits your target, but then what do we have here? Rejections of this area. So then you start selling. Because you see all these rejections in this area, but your plan doesn't say trade the rejections. Your plan says trade the break and the retest. So you start selling here, looking for price to come down to this area again. When what did price do? It came down a bit, you would have been in profit. What did it do? Break, retest of this area as you see the wicks into this area, and then boom, price went straight to the upside and you would have been stopped out. So, you know, it's not the best example of trading plan, but you know, I just had to think of one on the spot. But yeah, there are a few psychology tips, and just make sure you're not over risking. Don't risk 10%, you know, risk 1 to 5%. This isn't financial advice, but this is just what I personally do. Risk, you know, 1 to 5% max, maybe even 1 to 3%. And then that ensures that, you know, you can't blow your account or lose a large amount on one trade alone. So if this video did help, leave a comment down below future videos that you want to see, leave a like and subscribe, and I'll see you in the next video.